Welcome back to the channel of truth, trust, and transparency. Now, the reason that I'm staring at you weirdly like this is because in the previous video, when I blinked before I said that sentence, some guy with the handle Saint_Monaco pulled me up in the comment section. So I just wanted to make it really clear that I said that without any hands, fingers, or toes crossed, and I didn't blink. But now that he's over and I can blink, welcome back to the channel. Today I'm going to talk to you about a couple of things to think about if you're buying property with another person. Usually people come up to me with these ingenious ideas of buying property with friends, buying property with family members, essentially other people other than who you're going to get married to, your life partner, whether it be husband, wife, whatever it is. I want to give you guys a little bit of learnings, a little bit of lessons, things to think about it. Me personally, I tried this. I bought a couple of properties with my brother. It probably actually slowed me down in terms of my portfolio journey. It's not something that I technically advocate for. It gets a little bit complex, and I just think that people think short term rather than long term when it comes to this. So the most important thing, or the first thing that you want to think about, is structure. Now, this is something you need to talk to your solicitor or conveyancer about. I am not either one of those. However, I'll tell you I'll give you a little bit of education around how it works. So there's two types of structures. One is called joint tenants. You can buy the property as joint tenants or joint tenants. Now, what this means is that you both 100% own the property together as joint tenants. It also automatically means that if you buy it under joint tenants and one of you dies, so if you buy it with your brother, your sister, and one of you people die, the entire ownership is then given to that other person, regardless of what is in your will. So if I'm married to my partner and I own a house with my brother and in the unfortunate circumstance I pass away, that property is then fully owned by the other tenant, which is my brother, not my spouse. So very important to think about. The next sort of ownership is tenants in common. Tenants in common. Now, this is more flexible. And if we're talking about the exact same scenario, that is where the will come into play. And you can split this up proportionally however you want. You can own it 95-5. You can own it 50-50, 60-40, however it is. You can split it up. A little bit more flexible. And if either party that owned that was to pass away, if either party was to pass away, then their particular portion, it would go to who is allocated to that in their will. So one thing to think about straight off the bat is going to be the structure. The next thing I think a lot of you guys may or may not know, and obviously talk to a mortgage broker about this. Again, I'm not a mortgage broker, but when it comes to the loans, when it comes to the lending side, because what happened in my case and what happens a lot of the time, now there's new policies and stuff around this, so some banks may be able to see through it. Most banks don't. But let's just say you buy the house, right? And the house has $1 million of debt. So the loan size, and it could be value, let's just say you've bought it for $1.2 million, 20% deposit, big boy deposit there. Now, $1.2 million property, let's say that it's renting at 4% yield. Pretty decent return on a $1.2 million property. That's $48,000 a year. $48,000 a year in rent. Now, what a lot of the banks will do, because let's say I own this 50-50 with my brother, what a lot of the banks will do will say, okay, David, when I go to, so let's say I've got my first one with my brother, then I want to go again and buy my own one. What a lot of the banks will do will say, okay, David, we're actually going to calculate your serviceability based on you having $1 million of the debt, full responsibility over the debt, but because you only have half, because you only own half, we're only going to give you half of the rent to service that debt. Which that means I've got $1 million of debt serviced by, now it's a 2% rental yield. And remember, most banks will go out there and say, before the serviceability buffers has been brought down, post 6% interest rates, banks will go, oh yeah, well that debt will cost you $65,000 a year. Oh, they'll shave a bit of that off, and you're only bringing 24. So you're negative $40,000 a year. Let's just say it's $40,000 a year in repayments for that property, right? Now, if you think you're on $100,000 salary, you're roughly paying about 22 grand in tax, leaving you with $78,000 post-tax, living expenses, household expenditure measure, which is HEM. If you don't know what HEM is, essentially what the banks will do is they'll say, okay, you're a X-year-old male. We're going to say that at your age and your income and your job, you're earning X amount per month. You're spending, let's just say $2 grand a month in living expenses, whether I'm over that or under that. If I'm under that, they bring it up to 2. If I'm over that, they'll use over the 2. But they'll go, okay, well, we know that you spend $2,000 a month. That's 24 grand. That's $24,000 a year in expenses, plus your 40 grand, that's $68,000. Oh, and your salary post you paying tax was like, what, 70, 72? They won't allow you to borrow anymore. Now, there is potentially some banks that will work on only 50% of this. It does get complicated, and there's not too many that do. Obviously, less banks, they might come through and give you a little bit more to borrow. But that's one of the issues that I particularly ran into on the early stages of my investment, in my property investment journey. So one thing you need to think about is, it might be good for a bit, but if you want to go off and buy your own shit or buy after that, it could impact you drastically. The next 3 things I want you to think about is going to be 1, life happens. So here's your issue. You sit down, let's just say it's a family member or it's a friend. You are really good friends at the moment, or your family members. How many of you, if you looked back 10 years, still have the same friends today as you did back then? Is your best friend from 10 years ago still your best friend today? Or have a look at your relationship with any of your family members. Is it still the same in 10 years? 10 years ago? Is your lives the same 10 years ago? Does potentially one of you have kids now, or has another partner, has a new partner, has got married, all those sorts of things. What I want to get you guys to think about is that life happens. And the issue with this is that when you come up with this great idea that, we'll buy a property together as best mates, life happens. Your best mate could want to move overseas, could lose their job, could say, change their mind in a few years. And if, as you guys have seen from my other videos, if you change your mind after 1-2 years, the property maybe hasn't had that much growth, then you might actually lose money because you're paying your entry and exit fees, stamp duty, LMIs, selling costs, CGT, all those sorts of things. You potentially will get hit by so much cost that you haven't made money. So you might actually lose money because life happens. They might have a kid and say, Dave, I need to sell that property. You go, hang on, I don't want to sell it though. And they go, okay, well, buy me out. Okay, but I can't get access to the rest of that half. I don't have the money available. So the issue is that you're not probably fully aligned. You're not going to be fully aligned. There's nothing wrong with that. Life happens, people change, people come in and out of lives, divorce, marriage, kids, new jobs, moving, PPR. Maybe the time you have that deal together, you're both single and you're both wanting to, run through a brick wall. Then either one of you people meet a life-term partner and you want to get married and you need the money and the money you put is in here and you want to get it out. Life happens. And I think the only real person that you are going to be fully invested with is going to be that partner that you're marrying, your spouse, husband, wife, whoever it is. That's who I would go down this route with. I wouldn't probably recommend going down with, mates or siblings. Life does happen. So that is the issue that you need to consider, is that you're not always going to be aligned for that period that you're going to hold the property. The next thing that I want you guys to think about as well is going to be the work ethic. Right. So, as you would know, a property does, though it's sort of a passive investment, there are things that you need to be focused on. There are things that you need to do. The property manager is going to call you up. It's going to need to be rented out. It might need a renovation. Now, it might have maintenance requests once you get tenants. It might have requests from tenants. You've got end of year tax time that you need to be able to, accommodate and gather the documents for. You've got all sorts of bills that need to be paid. You've got insurance that needs to be organised. Now, my issue or my question to you is going to be the work ethic. Are you two people that are buying that property together going to put in equal amounts of work to research, buy, plan, purchase, maintain, and manage that property? If not, then, one person's going to be putting in a hell of a lot of work and one person isn't. Then that person that is putting in the work is going to feel like they need to have a bigger, be remunerated differently. Think about it. If you held a property for 10 years and you put in all the work and that person that you bought it with was not involved, whatsoever, are you gonna think that's an equal 50-50 split? That's a lot of work and a lot of time and your effort that you haven't been remunerated for. So how are you going to capture that, or how are you going to make sure it's divvied up evenly, especially if potentially you guys agree on something and then that other person changes their mind, or again, life happens, there's a kid that they sort of forget about the property. Then you're left with potentially a fixed percentage, 50-50, and you're putting in all the work. So you really need to think about, even if the property needs to be renovated, are you renovating it with someone that has that same work ethic, skills, knowledge? Are we talking about me that is a tradie and a chippy, and I want to buy it with my best mate who, is a investment banker that hasn't held a tool in his life? Okay, but if I'm putting in all the work for the renovation and then that gets a value uplift, am I going to be remunerated for that? How is that going to look? It gets very complicated. You guys can see why I'm not really a fan of it. And the next is going to be equity. Now, as I said, life happens. You potentially want to build, or the property, let's say you've went down this path, right? And you go, hey guys, I want to withdraw some equity, right? You say to that person that you own that property with, you go, hey, I want to withdraw some equity. You say, no problems, let's spitball a situation. We have this property here. Your property goes up to 1.4 mil. Right? 1.4 mil. There's $200,000 of usable equity. So ideally, there's 100K each that you guys can tap into should you be able to service it. Let's just say you can. There's 100K each. Now, if I say to you, and we own this property together, I want to withdraw it now. Right? I withdraw that 100K now at 6% interest rates, and I'm paying 6% on that. Now, let's just say in 2 years' time, you come out and go, oh, Dave, I want to do it now, and it's 4%. Now, how are we balancing that? Are we still, because now we've got these equity loans, there's more money required. Am I responsible for this and you're responsible for that? Or because we own it 50-50, we both have to put in for it? But what if the person that is stuck with the higher interest rate says, maybe they're stuck on that for 12 months, says, oh, but that's unfair. I'm paying more money. You got it for cheaper money. You know what I mean? Or when you pull it out of that loan, what if I need $100,000 and there's only $100,000 to pull out, and then that other person has to wait 3 years until the property grows so there is enough usable equity to pull out. Is that going to be fair? I'm not saying it is or it isn't, but I'm saying that that's something you need to think about it. So to probably summarize this, I think, and why I don't usually like it. Now, I know what you're thinking. It can have its pros, and I will try to be as subjective as possible. And obviously the pros are it allows you to get into the market slightly quicker, if you pull stuff together. But I just think you guys really need to think about structure and these 3 points, to have them very, very crystal clear, to have a game plan for that particular property. Why am I going into it with this person? Do I actually trust this person? Has this person been in my life for long enough, and has the next years clear? Or is there something on the horizon that's going to come up and absolutely sink this ship? What does their life look like compared to yours? What is the work ethic? If you're a person that, puts in a lot of time, a lot of effort, you're good with documents, you're good with numbers, are you okay with taking on that burden and not being remunerated for it whatsoever? Equity-wise, what is the actual game plan? Or are we going to document that no equity is released from this property apart from when we sell it? And another thing as well, let's just say that that's what your plan is, and we say we sell it in 5 years. What happens in 5 years if that property hasn't grown? What do you do then? Do you hold on to it, or you just sell it at a loss? It's a bit of a risk. So 3 things to think about technically and then it can also get messy with, what happens if, we pick potentially maybe, let's just say, a trust structure. What happens if that person that you're in it with can't afford to pay any of those bills, or can't afford to pay that accountant's, ongoing costs? What happens there? There's a lot of questions, and as you can see, it's probably why I would lean away to it. Another really good alternative is potentially guarantor, a loan from your parents or something like that. You can get a loan from your parents, use that as the deposit, paying back, or guarantor too. There's a few other options available and possible that I personally would explore, but at the end of the day, you're not trying to save up too much. These days it's $70,000, $80,000, and depending on how much money that you can put away, I've put on, if you're just new to here and you're thinking, look, it's going to take me forever, go back and watch the video I put up of how I saved 100 grand, and there'll be some ideas in there that you can fast track. Remember, live your life in seasons. If you are saving for your deposit, strap in for 2-3 years of pain, but just know on the other side of that, once you get that first purchase out of the way, it definitely becomes a hell of a lot easier. So that, my friends, is if you are buying property with a sibling or family member, that's what you need to consider and think about it. Let me know your thoughts, queries, and questions in the comments below. But as always, I'll see you tomorrow.